Hey, how's it going, everybody? Mike Weber here, your Los Angeles real estate broker. And today I want to share with you why right now may be the best time that I've seen to sell your rental property here in California, in greater Los Angeles, and invest that money elsewhere where you'll probably have a lot less heartache and a lot higher returns. So recently I put up a video that showed what the numbers really looked like if you purchase an investment property. In that video, the property that I used was a 4-unit rental property here in the Los Angeles area. It was priced at $1,550,000. And really what the net takeaway from that video is that if you had to get a loan with 25% down, you were basically going to have a massive negative monthly payment. And then if you had cash, 1.55 million to put into a property, you were going to have a very, very small return. It's about $3,500 a month or $3,000 a month, and about a 2.5% cap rate, which is really your return on your investment. So you'd only be making 2.5% if you put 1.55 million into a property. Now, obviously, that's not very good. So I want to talk about some alternatives today that in my view are far better and ultimately a lot less hassle than owning rental real estate here in California right now. Now, obviously in California, we've been having some tough times. We've had a lot of inflation, so the cost of everything is rising for landlords. And at the same time, the rules and regulations have gotten a lot more difficult for landlords. So you're limited on how much you can raise the rent. You have a lot of difficulty getting tenants out if they don't pay their rent. And at the same time, all of your costs are rising across the board for everything related to the property. So insurance costs are rising, maintenance, repair costs, any work that needs to be done by contractors. Obviously, property taxes go up over time. So you have these increasing costs that a lot of times are hard to recover. And then if you try to raise rents too much within the limitations of what you can, you run the risk of having tenants stop paying. And then it could take years to get them out based on all the laws we've experienced, etc. So what if there was an alternative where you could do much better than just sitting on a property, maybe that you've owned, for 10 or 20 years or 5 years, or maybe even that you're thinking about buying now? That's what we'll talk about today. I do want to say this is not financial advice. Obviously, before making any investment decisions, speak to a professional, speak to your financial advisor. And also, in full transparency, I do own some of these names that I'm going to share with you today. I will likely buy more of them, or I may sell them if conditions change. So I just want to let you guys know that. So before we jump in, I do want to say if I can help you with any real estate needs here in Los Angeles area, definitely reach out to me. I'd love to do that. Don't forget to like and subscribe and share. And let's go ahead and jump in and show you what I'm talking about. All right. So real quick, before we get started, a little background on kind of the commercial real estate scene. What's been happening in commercial real estate is that as interest rates have risen, it's created a lot of pressure on the commercial real estate space because loans in commercial real estate are generally short term. Unlike residential loans, they're normally for 5 years or 7 years or 10 years. And so what happened is a lot of commercial real estate was financed before rates went up, which means the price that they were able to pay for the property was very, very high because the interest rate was so low, so the overall payment was manageable. In addition, a lot of this was pre-COVID, and so there was not a lot of vacancy. Most commercial real estate was fully occupied. The rents were strong. Everything was good. And then COVID hit and there started to be a whole lot of vacancies, a lot of tenants that couldn't pay anymore. And then in addition, the rates started going up. So the space that we've been in for a couple years now is that a lot of this debt is rolling over, and now they have to refinance this debt at interest rates that are often double or maybe even in some cases triple what the previous rates were. And so the problem with that is that a lot of times these properties are now upside down or in negative territory, and this is creating a lot of problems in commercial. And so what's happened is there's all kinds of real estate investment trusts out there that are yielding very high dividend yields, dividend returns as a result of the price falling so much because of kind of the landscape that we've been facing or that commercial real estate has been facing. And because of this, there's a lot of opportunity out there for the savvy investor or the smart investor who, one, can either go out there and analyze these REITs very carefully themselves and understand the risk that's inherent in them, the likelihood that they'll have a lot of defaults and bankruptcies, or that goes to their financial advisor, financial professional, and does this work with them. or somebody who goes out there and buys maybe an ETF that's composed of multiple of these different REITs all in one basket to somewhat mitigate your risk and create some diversification. Obviously, again, speak to a professional before you make any decisions. So what I want to share with you guys today is an example of what I'm talking about, where you have these ETFs that are a composition of a whole bunch of different REITs included in one basket. So there's some risk mitigation there, some automatic diversification, and it also alleviates you from having to do a lot of due diligence on each individual REIT to make these risk determinations, likelihood of default, bankruptcy, all these kinds of things, because you're kind of spread across a whole bunch more REITs all in one basket instead of just owning one or two or three individual ones. Now, one REIT that I own that I really think is a pretty interesting proposition is MORT. That's the ticker symbol. It's VanEck Mortgage REIT Income ETF. Now, this REIT here is obviously designed to generate income. And amazingly right now, because the price has come down so much over time, particularly after COVID hit as rates started rising, that it's currently yielding 13.64%. Now, that's pretty amazing. Just recently, the price had fallen even more on this. As you see here, it was last week actually, where it got down to around, I don't know, $8.95 or something like that. And that had bumped up the dividend yield on it to 14.5% or around 14.5%, which is pretty incredible. Now, if we look at the composition of what this ETF is holding, we see that they have 15% Annaly Capital Management, 13% AGNC Investment Corp., just under 10% of Starwood. They have some Rhythm Capital, some Blackstone. The top 10 holdings are 69.3% of the assets that this particular ETF is holding. And you could, of course, go in here and you could do research on each of these companies. Some of them are paying massively high dividends or have a massively high dividend yield. Like here, we'll look at AGNC. They currently have a dividend yield trailing 12 months of 17.05%. So these are massive. Now, obviously, there's inherent risks on this stuff. Like I said, you have to obviously, know what you're doing, do your due diligence, or work with a professional can help guide you. But importantly, these are amazing returns. So the point that I wanted to make today is that imagine you have a property that's sitting there worth $1 million. And after all your expenses and all the stress and all the heartache and hassle, you're walking away on average with $2,500 a month, $30,000 a year. Well, the amazing thing is right now you can get a 13.64% yield. So really, if you had $200,000 in capital, you would almost be making the same amount of money if you were to invest in a mortgage ETF like this one with zero hassle, zero stress. So you have $1 million asset sitting there, barely generating, $30,000 a year, or 200 and some odd $1,000 invested in something like this could also generate that same amount of return dividend yield to you each year. And there's no management hassles, there's no stress, there's no tenant problems, there's no big unexpected repairs, anything like that. And what could you do with the other $800,000? Imagine you could diversify that across other investments. There's a lot of different types of investments that are even non-real estate related that are generating 6, 7, 8, 9, 10% right now that are available. There are other dividend ETFs that are just different compositions of stocks that are generating 6, 7, 8% right now. There's all kinds of opportunities out there to make investments that have much, much higher returns than real estate. And I think it's a very compelling argument that it makes an awful lot of sense to pull money out from real estate and invest it in much higher yielding assets that really have a lot less stress and hassle to manage and to maintain and to own over long periods of time into the future. Now, somebody could say to me, Mike, yeah, but what if interest rates go even higher? What's going to happen to the companies in these ETFs that we're holding? And I would say, well, yeah, that is a very real concern. And I think that it's very likely that interest rates are going to stay high and probably stay high for a very long time, contrary to what most people are probably saying or most articles that you're reading. Now, the reality is if that happens, that's going to be very bad for commercial real estate, and likely the prices of these REIT ETFs or these REITs in general are going to do poorly. They're going to come down because it's going to create a lot of pain in that space. There's going to be a lot of defaults and bankruptcies and all kinds of problems. But I believe the same thing is going to happen in residential, small mom and pop, multi-unit, sort of real estate. If rates go higher or they stay high for years and years, prices are going to have to come down in residential real estate. And actually, I think in a lot of ways, there's a lot more risk for the small mom and pop owner, particularly if they're leveraged up, meaning they have loans on the property. And the reason why that is because let's say you were to buy that $1.5 million property that I did the video about recently, and you just put $400,000 down, roughly 25%, and you have this huge negative payment. And let's say interest rates stay high unexpectedly for 10 years or 15 years, or they go higher. Well, what's going to happen is that the value of that property is likely going to have to come down substantially. So let's say the value of that property goes from 1.5 million down to $1 million. You've lost $500,000 even though you only put $400,000 in. So in reality, you've lost more than 100% of your investment on that property if that were to happen. Now, let's say you take that same $400,000 and you invest it in some of these mortgage ETFs. And there's other real estate ETFs as well that are a basket of different stocks that you can invest in. You put that same $400,000 in there instead of buying a property. And now you have, let's say, $40,000 a year coming in, $45,000 a year coming in. And let's say interest rates stay high for a long time, same scenario. Well, let's say maybe all of those REITs that are in that ETF that you purchased drop by half. So the price goes down on your holdings from 400,000 down to 200,000. Well, guess what? You lost only 200,000, whereas in the other scenario, you lost more than 100% of your money. You lost around 500,000, even though you only invested 400,000. So either way, there's a lot of risk there one way or another. But importantly, if you take your money from your investment property, if you sell that and you invest it in a diversified basket of different assets, for instance, a REIT ETF, maybe other ETFs that have a lot of high dividend paying stocks, etc., you probably have pretty good diversification. You'll ultimately have a lot more income than you're generating from holding this real estate here in California. And in the long run, you'll probably have a lot less stress and a lot less hassle from dealing with tenants, maybe more inflation problems, even harder and more strict rules against landlords in California, etc. So I hope this information was interesting and useful. Again, if I can help you guys with anything, reach out to me. I'm here to help. Thank you guys so much for watching, and we'll see you on the next one.